for today, I have a very cool topic, fresh off the oven.
I love it. Let's do it.
It is the tax inflation adjustments for the IRS from the IRS. So basically, this is the new, I would say, rates at what dollar they hit, the new standard deduction, the new lifetime exclusion numbers. Everything has been adjusted. Not everything, but a lot of things have been adjusted for inflation. So let's talk about these now. All right. So I think it comes through revenue procedure. So the IRS publishes these like revenue procedures, and that's how they communicate with the public. And one of them is revenue procedure 2022-38. So it's the 38th revenue procedure of the year. And this is directly from the revenue procedure table. So table 1, section, married individuals filing joint returns and surviving spouses. The new number, top tax bracket. You're going to be in the top tax bracket as a married individual or as a surviving spouse when you are over $693,750.
Pretty big number. That gets you into what bracket specifically?
37. I think the one that I care about truly is when do you hit the 32% bracket? For me, that's a big one.
Totally, because that's the biggest nominal jump here. Well, no, the biggest nominal jump is 12% to 22%. But then the next biggest one is from 24 to 32. And for those following along, your income, if you're filing jointly, between $190,750 all the way up to $364,200 is all falling in that 24% marginal bracket. So that next dollar, $364,201, is an important dollar, not because it kicks you into another bracket, quote unquote. It's not like you pay more tax if you earn that money. That's a myth. You need to learn what marginal brackets are. We'll make a separate video on that if you think that that's the case. But it is important because that next dollar gets taxed pretty differently, up at $364,201.
Yeah, exactly. If you're married and you're filing jointly, right, this is the number you kind of want to look at. In this case, I think there's a lot of implications there, but we'll talk about it in another video. So for a single person, it's 182. So it doubles, right? 182 for single, married. It doubles for the 35% bracket, but for the 37, it does not double. Another thing, the AMT, it goes up a little bit, starts to phase out at 578. I think this is the HSA, right? The medical savings account.
This is a deductible change. It's a change in the amount of deductible you have to have in the plan. You have to have an even higher deductible for these to qualify to get a medical savings account that's pre-tax.
But the amount you can put into the HSA, did it go up? No, right? Oh, yeah, it did. No, it didn't.
I don't see that on this page. I think it might have because 401ks went up too, right? This isn't a comprehensive list. This is really just like tax brackets that are going to apply on your 1040 and some certain federal tax credits, but this doesn't have 401ks and such, and HSAs and other adjustments.
The foreign earned income exclusion went up to 120. That's a nice round number to know. 10K
that is
a month.
Nice. Yep, I'll take that.
The lifetime exclusion went up to 12.9. We're going to breach 13 maybe next year, which is going to be interesting to see where it goes down to afterwards.
Yep.
The gift exclusion went up from 16 to 17. That's a nice jump. Whole number.
Yep.
Yeah, I wonder how much you can put into 401k.
Did you find the IRS website version? I'm only finding like third parties.
No, I found 3 parties. It just says the same thing. Mercer has projected it going up to 22,500.
Quite a lot.
That would be nice. Could you imagine?
I was just talking to someone this morning about how much it was last night, about how much people hate their 401ks. 401ks are not a popular thing. People don't like them. In 2022, at least. I've heard several people say, all the money I put in, I've lost it, right, in investments. I put in a bunch of money. It went down by more than the amount that I put in this year. Well, next year you'll have the chance to not only do that, but lose even more.
But you have to think about it. What would happen if the market goes up? There's times in your life that you could be making more money in the market than in your income. So why work?
True. That's a rule of thumb, I think, from Nick Majuli's book. He talks about that. And it's about the use of your time. I think he says if your portfolio returns won't be anywhere close to your income in terms of dollars in like an average year, you shouldn't be that worried about the details of your portfolio. You should go pretty simple and just keep it easy. If your portfolio returns start to eclipse your income numbers, that's when the details of what you're invested in really probably should be highly dialed in.
Is there anything else on your mind that someone should review before year end?
We're recording October the 19th. This is a good time if you don't regularly check on your 401k contributions and you're just automatic, oh, I'm at 6%, I'm at 8%, whatever. Go look at your pay stub or go look at your 401k login and see where you're at year to date. And if it's your intention to max out, you need to do a little payroll math, make sure you're going to max out, because those need to fit into payroll cycles. So if you change it and there's only 2 payroll cycles left, you only have however much cash is in those checks to actually get this done. So that's one of my favorite things to check in October so that you can dial up or dial down as needed into your payroll deductions into your 401k.
There's a couple of other things that I would be Roth conversions. We've spoken about this in detail across the show, but like we need to bear in mind that Roth conversions, when the market is down and when your income might be lower than average, it might be a very good option for you, especially if you again are in the 24% bracket and you haven't filled up that bracket yet. It ultimately really depends on where you're going to live in the future. Like if you live right now in New York City and you're a high income earner, and you're planning to moving to Florida and becoming a mid income earner, now maybe it isn't worth it. Like maybe just stick with the 401k because it's an arbitrage
deferral.
Yeah.
Yep.
So you're deferring your income now. You're smoothing your income across the many decades. If you have the opportunity to do a Roth conversion today or now, sooner than later, it might be the right time. How do you go about doing a Roth conversion?
Yeah, so there's a couple ways. If you have money in an IRA, you've rolled over into an IRA, it's pretty straightforward. You need to contact your custodian, make sure you have a Roth IRA available at your custodian, and they'll help you do paperwork to complete a Roth conversion. You do have the opportunity to withhold or not withhold on that.
What do you suggest there?
I suggest
if you have the money sitting in your bank account, you have because you haven't invested this year because you're afraid.
Yeah, if you have excess cash sitting around, not withholding sounds great because you're getting all the bang for your buck. You're getting that entire investment amount into a Roth. So the younger you are, the more valuable this is as well. The longer time frame of compounding and tax-free growth you have. The other possibility is that some 401k plans have what are called in-plan Roth conversions. So for those of you that have mega backdoor Roths, we've talked about that before, that requires in-plan Roth conversions. That means you could take a portion of your balance that's traditional or pre-tax in your 401k and do it in there. That should also have some sort of workflow through your login through your 401k, whether that's Fidelity, Schwab, Vanguard, whatever, Empower, you name it. You should be able to initiate a Roth conversion there, as well as do withholding. You will get a 1099 for that. Don't forget that if you're doing tax projections. Very, very important. If you add $10,000 or $20,000 or $50,000 to your taxable income, that really matters. And that goes back to the discussion we were just having about tax bracket management, right? If you're trying to stay within that 24% bracket, this is not that trivial, honestly, because the brackets apply to taxable income. And if you've ever looked at the first page of a tax return at 1040, you'll notice there's like answering the question, what is income, is a very subjective and difficult thing. There's total income, there's adjusted gross income, there's taxable income. There's a bunch going on there. So be careful probably consult a professional before doing that on your own, unless you really know what you're doing.
100%. I will say there's a couple of things I would do. The first one is I would do a pro forma kind of like estimated tax return for the year based on the information I know right now. So if I know I'm going to earn, I have a couple of more pay periods, and I know how much I'm going to earn. I look at how much of this has been withheld so far. I look at everything, and then so I can actually put together pretty much a tax return, what it looks like by the year end, and then I can choose how much more money I want to pay taxes on. So if I'm earning, let's say, $150,000, I'm married filing jointly, and I have, in my IRA, I have, $280,000 sitting there. I could actually easily add another 100, convert 100,000 into a Roth, assuming that I have the cash to pay the taxes, and I would be adding, more money to my income, essentially pay more taxes. It would still be filling up the 24% tax bracket. And in that case, if I'm able to pay the taxes from my own pocket, I'm essentially adding $100,000 into a Roth IRA, where the equivalent money of that in a regular IRA is above 100,000 because I'm paying the taxes already. Essentially, you're just implicitly you're adding more money to the Roth IRA than what you're converting.
Roth dollars and pre-tax dollars are not 1-to-1. It's a really funky kind of like trade-off world there. I've heard people go through and do research on this. Do you know where you stand on the general kind of temperature of pre-tax versus Roth? Have you read that research and kind of made a determination on where you stand on that?
I end up running a typical Roth conversion spreadsheet that I have, because at the end of the day, it really depends which state you're from and where you're living. Because if you're living in Florida, your conversion might be better than if you're living in
not so much conversion. I don't even mean conversion. I mean contributions. So, for instance, do you have just a gut decision? I agree. It comes down to the kind of the same answer of someone in the 24% bracket doing Roth 401k versus traditional 401k. Do you have a strong opinion one direction or the other?
24% tax bracket depends the state again as well. With the, if you're going to end up in a 10% lower tax bracket, that's really hard to swallow regardless, right? So, but let's assume you're in the same state tax bracket when you retire. 24% to me is a slam dunk.
For what?
For conversions. I would fill up that tank.
Not for conversions, for contributions. Roth 401k contributions versus pre-tax. You would go Roth 401k?
Yep. Yeah. It becomes very clear if you're self-employed.
Yeah, that's way easier. Yeah.
If you earn too much money, you lose, what do you call it? The qualified
QBI.
Qualified
business income deduction, yeah.
Yeah. That deduction is a game changer. Like if you're below there, you save so much money. If you're phased out of that and you have the capacity to be phased in by lowering your income, I would lower my income.
Yep, you do that.
Especially if you're in New York. It just makes so much more sense. And the fact is, like, California people and New York people usually end up they end up retiring in another state that's lower taxes. So it usually ends up being more favorable for those people to just
go traditional, defer.
Yeah.
Yep.
And then you add on top like self-employment, and it closes the door for any sort of Roth conversion trend. That's why they're not so popular here. Yeah, that's where we're talking about. That's two things: rates, Roth. We're missing the last part of the R, and this has more to do with economics, which is recession. I did not imagine we were going to talk about this in this show. I did not imagine that the market would breach the June lows, but there's a good chance if they haven't done it, they will do it. We are clearly heading towards a recession. I think now, what is it? The probabilities are higher than 50% that we're going to hit a recession in 2023. let's say we go into a recession and there starts to be more and more layoffs, it's just sentiment, in my opinion. There will be another problem, whereas if inflation continues to run high, companies will start to protect their margins, and if they can't raise prices enough because the economy is not doing well, then they'll start to fire people. The final R that I was thinking about today is returns, rolling returns. So double R, I get 2 prizes here for using 2 R words. If you look at the S&P 500, the 100-day rolling returns, it is pretty close to what the 2008 recession was. Well, pretty close now. It's like it's breached the 16% or 15%, which is usually in very big corrections. So the 2018 correction, this is rolling periodic return of a quarterly, right? So it's not particularly rolling, but you can definitely see 3 periods of negative return here. We'll do it, right? First quarter minus 4.6, minus 16, and almost minus 5. You get the gist. It's a big. The last time we had that was 2018.
Six in a row. Holy cow.
Yeah. And so we've not had 6 in a row for now, but you could easily see having 3 in a row. This is more likely the case that we're going to endure. We're probably going to have 3 or 4 in a row, then one positive, then maybe could be another negative, and then another positive, another negative, and until we finally, have corrected. It's brutal out there. Brutal. And I know this is already going beyond this topic, but I find it very hard to swallow the increase in the VIX. So the volatility just continues to creep up, right? Like we've been in an upswing since 2018. It just continues to go up. It has massive spikes in the middle, but the long-term trend has been upwards. This obviously can't last forever, and we have had periods where we have had growth in volatility, but for the most part, it's more like there's a big spike, and then afterwards we come down. So in this case,
why can't structurally higher volatility just hang around?
It could. You're just going to look at much lower valuations, but looking forward, higher volatility equals lower valuations, lower multiples. There will be a point where those multiples will come down and they'll stay down, and as long as we have this type of volatility, it will likely stay compressed.
To me, higher rates and structurally higher vol make sense side by side.
The other part I want to talk about, the other R, I continue with my R's. The Redbook, United States Redbook Index, it's an index of retail. It's basically retail same-store sales. It measures a specific location's sales, and it tries to eliminate whether a company opened new stores or closed stores. So it takes on the same store sales number, only looks at stores that have been open for a year, so they have kind of stabilized their sales numbers. They don't get a big pop from opening up a new store. So it looks at retail locations that have been open for more than 1 year, and it looks at their same store sales. So basically, how much have they been selling? And retail sales have been slowing down, but it's been slowing down recently a lot. Went from 12% analyzed to 8%. And that's, I don't know. I think that's the future. This needs to come down significantly if we're going to have lower prices. So industrial production was up. It'll be very interesting to see in the next couple of days what the housing starts are.